I thank Chairman ji, Murtuza ji, Sweta ji, Ankit, Gautam, Saurabh ji, and all the dignitaries off the desk, on the desk, and the convener Ritu, and co-convener, deputy convener Sheetal, to invite me to discuss on the topic which is of vital interest to each of the participants, as I understand from the communication that are happening between me and them. But let me tell you few things. I have a peculiar way of conducting the session, and which I want everybody to be familiar. Normally, all the participants ask the question. As a speaker, I will ask the question, and all of you have to answer. And I have a format of question in 3 types. First type, slow poison, whereby I will pose a question to anybody, and if that person is not able to answer, he will pass it on to the next person, and so on. Format number 2, heart attack. Anybody would be asked from the section, especially the person who is sleeping. The intention is nobody should sleep. So be aware. Choice is yours. I don't have a problem. Sometimes speakers can be boring. Third, bubbly popcorns, where the question is extremely easy. Anybody can answer, except me. Okay? So let us begin the session. My first question, which I want, it's a bubbly question which all of you can answer. 2 plus 2 is equal to what? Very simple, anybody can answer, right? But when the same question is asked to a smart accountant, he will say, आपको कितना करके चाहिए मुझे बता दो, हम हमको बना देंगे. And that is what we are known for. But I will say, I'll remember the movie Do or Do Paach. My session today is divided into 5 parts. And in each of the topic which I am going to deliberate, I am going to create the foundation which would act as a support for the interplay that I will do during the discussions. So foundation is very, very significant. I would urge each one of you to pay the 100% attention. I would request everyone to focus on the screen and rather than looking at the speaker, because the speaker is not photogenic. So speakers, your slides will be very, very interesting. So please pay a complete attention. And this presentation would be shared to all, bearing few slides because of the certain reasons. But majority of the presentations would be shared. How many of you people have watched the movie Diwar? Almost all? There is a famous dialogue under the bridge where Amitabh and Shashi Kapoor is standing, and Amitabh says, I have a bungalow, I have a car, I have everything. And Shashi Kapoor says, I have a mother. So same logic applies to me today. I have presentation, that's why I can speak, otherwise I can't speak. Okay? So today's topic, what we are going to cover, under the tax audit is GST reporting, disallowances, TDS reporting, and the GAAR. These are the four broad topics which I am going to cover. My session is of 3 hours, but since we are running little late, I will try to cover as much as possible. After a certain point of time, we will have a break for 5 minutes instead of 10 minutes. So all of you have to cooperate in that 5 minutes you got to manage. I will put the disclaimer first, because typically all the speakers put the disclaimer at the end. I am putting this disclaimer in the beginning. I may be correct in my views. I may be incorrect. My views are not binding on ICI as well as the study circle. I urge each one of you to read the law and then accept anything at a face value. And if I give any examples during the deliberations and which are similar to your clients, or they may be similar to my clients, please note I have no intention to disclose anybody's affairs. In this world, nothing can be said to be certain except death and taxes. It is said by Benjamin Franklin. And there is another famous proverb which says, penny wise but pound foolish. Now let us treat and explore the path of GST reporting, disallowances, TDS reporting, and GAAR reporting. I am not going to touch upon every clause of tax audit. Let me be very honest, because it is a very long discussion, and probably I can take, if I start speaking, I can speak up to 6 o'clock, there is no problem. But I will restrict my time, because I want another speaker to be given a fair time for the deliberations. Typically, tax audit is applicable to a class of taxpayers who are carrying on business or profession, and we report such income under the head profit and gains of business or profession. Today, since morning, we have been listening the technology developments that are happening all across, and the various examples that are given by the chairman sir as well as the secretary madam. Technology is the integral part of review aspect of the tax audit. But when we look at the tax audit form, it is only one form that we are uploading on the ITD website electronically. But the data that is getting transmitted across the various departments, and they use it using the artificial intelligence, automated examination tools or systems, and as well as the risk management strategies, which will flash mismatches or the incorrect reporting of the information in so-called tax audit report. Plus, system itself take care of assessment part, tax computation part, whether all aspects of audit, whether all aspects of ICDS, if they are applicable, whether they are complied or not. Same way, accounting standards, whether they are also complied or not. And this is what is happening at the back end. We don't even realize, and this is happening on a real-time basis. So probably I will not wonder that we file the tax audit report today, and within next 20 days we will get the order also. Quite possible. So we got to be extremely particular when we are filing the tax audit report. And there is one food for thought, whether it is a report or a certificate. I will say it is combination of both. especially what we are reporting in form number 3CA and 3CB, we are saying what is reported is true and correct. But how true and correct, that is all dependent on our verifications and the documentation that we maintain. And documentation is a key from various technology initiatives that are happening under the faceless regime. And as we know, under the faceless regime, things have changed like a sea change, which we never envisaged कि it will happen. And basically, when we talk about disallowances that are to be done, which are either express disallowances or some disallowances has to be done on a suo motu basis. Sometimes we feel, if I do this, my client will feel bad, or my client would be required to pay the taxes. But in a long run, if I look at it, if we do it at the source level itself, that will help client. They will feel bad at the initial stage, but you should explain them कि if this is done at the source level, we may not have any issues in future. That is my personal view. Everybody can take their own views. In my opinion, wherever it is mandatory to disallow, I would urge each one to disallow them explicitly. Same way, TDS is also another very significant thing. There is a public data available. TDS is contributing around 56 to 58% of the revenue of the government before the implementation of 194R and 194S. And mismatches arising on account of the 206 AB compliance. To imagine what could happen. In future, I may be correct to say we may have a separate TDS audit, which can be a great opportunity for all the members in general. Maybe it is my thought. Another thing, when we are doing the TDS reporting, we are required to report each and every reportable transaction. If interest is payable, then also we are required to report. Especially we are giving the declaration in our clause 34 saying all reportable transactions are reported. So imagine the statement that we are signing as an auditor. Before we go on to the subject, let's understand the tax ecosystem. We start with transactions typically of whatever, small, big, or whatever the size. We check the books of accounts and they are converted into the financial statements. And when I say financial statements, balance sheet, profit and loss accounts, notes, schedules, corporate, non-corporate, depending upon the segment in which we are doing the audit for. We help determining the computation under section 28, self-assessment tax, advance tax, proper filing of the ITR and the tax audit report. And once that ITR is uploaded, intimation is received invariably, which is nothing but a verification of a data in an arithmetical manner. There is nothing else. And typically, some of the cases are selected for a scrutiny, assessment, and if we are not happy with the scrutiny or assessment and there is a prima facie error, we go for the rectification. And typically, whatever we file, if it is accepted, there is no issue, or income may be increased or decreased, exemption may be allowed, deduction may be allowed, not allowed. A refund may be allowed, may not be allowed. And if we are not happy, then we go for the alternative dispute resolution as the first appeal. And we are not also happy with the appeal verdict. We go to tribunal, high court or a Supreme Court or a writ petition. as the case may be. Typically, our team is preparing the tax audit return, report, information, and I call that as a determination of a data. And as a principle, we do the ascertainment to ensure that whatever is reported is correct. My sincere suggestion to all, avoid using the cut paste. We have observed at times, last year's data is also repeated in the tax audit of the current year, invariably. Be very, very discreet when you are doing the ascertainment of the data to be reported. First point. We are familiar with this particular process, but here today's the whole discussion we will concentrate on method of accounting, which is mercantile. Cash method of accounting is very limited usage. This year, assessment year 21-22, we were only reconciling with 26 AS, but this year we need to reconcile the data with AIS, TIS, SFT invariably. When we do the filing or reporting, we will ensure a proper tax treatment is given. Whatever the tax benefits are to be taken by the client, we should claim, we should not leave that thing. Documentation and reporting is a must. TDS, TCS, advanced tax, self-assessment, GST reconciliation is a must. Especially the related party transactions are washed under lenses very, very significantly. At times we have observed data in the balance sheet and data in computation and ITR don't match. It's a very common thing because last minute some changes happen. Client will wake up at the last hour and they say, this to be done, and somehow it is missed out. But be very, very particular that the data matches. Another thing which we have observed, especially in the interior parts of the country, ICDS adjustments are done in the books of accounts. They are only to be done for the purpose of the computation. It should never form part of the books of accounts. Accounting standard has to be strictly complied. Statement of auditing, extremely to be complied. Sampling records to be maintained invariably. And there are a couple of ICDS which are applicable, which is not the part of the today's discussion. But that impact we got to show it correctly as applicable. How many of you have read the tax charter? Tell the truth. Has anybody read line by line, word by word? Please raise the hand if anybody has read it. Nobody. I will go to the tax charter for the taxpayers. How many of you have read? Again, no answer. It can be the great tool for each one of us to defend if any litigation arises. That can be discussed at the time of faceless assessment when we speak. But here one food for thought, especially how many of us go and do the shopping in the electronics market? Everybody? Typically when we go to the electronic showroom and we say we are looking for this particular product, we are told that this is available or not available. Same way we go to the chemist shop, same way we go to the kirana shop, we go to the supermarket. If the stock is not available, the person tells us instantly it is not available. But when I look at their IT returns, very famous comment, stock records maintained verified, maintained by the proprietor, partner, director, or extreme, stock records not maintained. Shop has a stock of 5 crore, ITR shows stock of 50 lakh rupees. How realistic it is? Are we taking care of, are we the taxpayer being the honest? Are they paying taxes correctly? These are the various aspects which are examined by the government under extreme lenses. Lot of deductions are also claimed, for which there is no supporting. We will cover up the section 32 situation where additional depreciation is claimed, but there is no manufacturing activity at all in the profit and loss account. It shows only trading. In that case, additional depreciation is not permitted. Why do we make such an attempt? Business course reporting, it's incorrectly done. And then it flashes. With this foundation, let me start with the uninvited guest. How many of you will agree it is uninvited guest for us? Please raise the hand. So only 5-10 people are saying. So 45 people agreeing it's not an uninvited guest. So I am happy. So 5 people are exceptions and 45 are the normal people. Okay? My first question to everybody here, how many of you have read the Income Tax Act? Read fully? Partly? 10%? 5%? 1%? I have not read anything. I'll tell you my story. I started reading the Act. One section I read, 4 days thoroughly. When I reached the last point, it was written omitted. So thereafter I told all my staff members, start reading from the bottom. So at least you are safeguarded. You have not wasted your time. So anyway, I will start GST clause 44 reporting with the food for thought. First question which everybody has in their mind, it will be deferred once again. Am I right? Okay, very good. So I am an astrologer now. Second question. If I put the disclaimer, will it serve my purpose? Right? Most of the people are putting the disclaimer. How many of you have uploaded the tax audit report till now? Or you are waiting for this session to happen? Huh? Waiting, no? Very good. So whatever you are going to learn from today, 10% of the fees are payable to the Chartered Accountant Benefit Trust, not to me. Let me be very honest. But let me say one more thing. All of us now know 9C is gone. That was the opportunity for most of us. Was that imagined by the government at the initial stage itself? That they will plan to remove it? That's why clause 44 was kept on the tax audit report schedule, form number 3CD. And now, as a chartered accountant, we are doing the authentication and validation of a data to be reported for GST reporting. And now it is to be done only by the chartered accountant. Earlier it was chartered accountant and cost and management accountant. But are we getting extra fees for doing clause 44 reporting? Why are you not asking? Is it not the extra efforts that you are putting in? you should definitely ask for it if you are doing it. Next question, is it beneficial to all the stakeholders? In my opinion, yes. Why? I will come back in the subsequent slides. But my first question which I posed, will it be deferred? No way. Don't rely on anybody. Please fold your sleeves and prepare reporting for clause 44. No excuses. Difficulty, systems not played, record not played, nothing will work. You got to report. What you report, how you report, we will see in the subsequent slides. First question that comes to my mind, who is celebrating? Taxpayer? Taxpayer though is always celebrating. He doesn't have to do anything. Everything has to be done by the advisors. Whether advisor is celebrating, advisor will celebrate only if he is paid for. Taxman, definitely. If you don't report, it is option for them to take a suitable statements like a best judgment assessment and issue the notices or a counsel. If the litigation arises, it is a bread and butter for the counsels. Am I right? But here that question comes to our mind. Do I need to be expert in indirect tax for reporting clause 44 information? How many of you exclusively practice in indirect tax here? All are general practitioners? Direct, indirect, both? Okay, fair enough. Anybody who is an expert in indirect tax here? I am not. I'm a novice. I don't know anything. Still I am giving the lecture. See, I have the presentation. Anyway, if you are an expert in indirect tax, it's a boon. But if you are not an expert in indirect tax, but you have a reasonable working knowledge of the indirect tax, then also it will suffice. Third option, I am not an expert in indirect tax, I don't have a reasonable knowledge in indirect tax, but I am an expert in direct tax. Then also it will solve the problem. No issue at all. You need to have certain documentation in place for reporting such information. Need not worry at all. I will tell you, need not worry at all. Most of the peoples are extremely worried about clause 44. In my opinion, we should not be worried at all. Why? Are we preparing our financial statements for tax audit report? Simple question. It is bubbly popcorn, no? Not preparing. Who is that person? Please come. Sir, come. Sir, come, no? Without financial statements, can you sign the tax audit? So you are preparing, no? So don't say that you are not preparing financial statements. You are verifying, that is okay. Reality is something different. See, Form 3CD is required to be prepared by the client. But client knows how many rows and columns are there and what data is required to be reported. My answer is no. Tell me who is reading Form 3CD in the assessment. Discuss practically. In my opinion, when physical assessments were happening, Form 3CA or 3CD, 3CB and 3CD was never looked upon at all. Am I correct? But things have changed now. It is seen by the system. It is considered. Every point that you are reporting is considered. So be very, very cautious in what you say and what you report in the tax audit report. Let us understand to whom it is applicable and to whom it is not applicable. I wish everybody would like to be in a not applicable clause. Am I right? Okay. Anybody, any taxable, any person, as defined under section 231, who is supposed to file the tax audit report, being a corporate or a non-corporate, in form number 3CA, 3CD or 3CB or 3CD, are required to report clause 44 information from assessment year 22-23. I think all of you will agree, assessment year 22-23 can be filed only from 1st April 22. Can it be filed on 31st March 22? No. यूटिलिटी नहीं था ना 31 मार्च को, नहीं तो वो भी फाइल कर देते थे. Correct? Anyway, any audit report that you are filing from 1st April 22, you are supposed to report clause 44. Now let us take one example. Madam, what is your name? Yes. Sana. Madam is doing a business, let us assume. She बोलता है चार्टर्ड अकाउंटेंट प्रैक्टिस में हो जानी है, मैं बिजनेस करती हूँ. वेरी सिंपल. She has done so much of a business, made enough money, but she was allergic to compliances. So she has not filed tax audits for the assessment year 18, 19, 19, 20, 20, 21, 21, 22. She says कि मैं पेनल्टी भर दूंगी, कोई फर्क नहीं, मैंने इतना कमाया है, पेनल्टी भरने में कोई तकलीफ नहीं है. Though she will fight, that is a different story. She goes to her friend who is sitting next to her. Tax audit report will be filed today. Will she require to report clause 44? Yes. She cannot avoid reporting clause 44 information. Be very clear about this particular fundamentals. Then there is another question that is there in the public's mind. Do I need to generate separate UDIN for the GST reporting? No. Only one UDIN for the tax audit report. Next question. By any chance, she has filed the tax audit report for assessment year 21-22 also. Very meticulous in terms of the time limit. Earlier she was not. But after the notices in the emails and the SMS we are getting on a time, midnight, 3 o'clock, compliance nahi kiya hai. So now she has become very regular. But she made a mistake in the tax audit report, and now the tax audit report is required to be revised. So in assessment year 21-22, she did not report clause 44. So now she is filing revised tax audit report for assessment year 21-22. Will she require to report clause 44? The answer is yes. So any report that you file of tax audit from 1st April 22 for any assessment year, you should report clause 44. Is this clear? Any questions on this? This is all foundation, huh? Next 3 slides are extremely important. I want everybody to pay 200% attendance. And if you pay 200% attendance, I will give you 300% marks. Okay? For reporting the expenditure information, will I go as per the financial statements or records which I have maintained for the purpose of ITR, or will I go as per the GST Act? Answer is, we should go as per only Income Tax Act, not as per the GST Act. So now if you have prepared financial statements as per the balance sheet which you use for uploading tax audit report, will you have any challenge in reporting the total expenditure in clause 44? No. एक्सेल शीट का टोटल ही मारना है ना, किधर तकलीफ है? पॉइंट नंबर 1, somebody will say, guidance note says we should go as per the GST. अगर मैं GST के हिसाब से जा रहा हूँ, if I have a single GST number, still I am safe. If I have a 38 GST numbers, what will I do? Will it be practically possible to do such reporting? Secondly, if we have a 38 GST numbers, we have 38 GSTR 9 and 9C. Am I right? And in income tax, do we have 38 ID returns? No. Only one ID return, no? I'm clear. Wow. And this reporting requirement is under the income tax law. It is not under the GST law. Please note, don't import GST concept into income tax. They are on a different footing altogether. Not to be touched at all. Second question, do I report only revenue expenditure, or do I include revenue expenditure plus capital expenditure? In my opinion, only revenue expenditure should be considered, excluding the depreciation, excluding the statutory provisions, which is like gratuity, provision for taxes, or taxes which are debited to the profit and loss account. So it is very simple. Let us imagine you have prepared your own balance sheet, income expenditure account. You have all the data. Excel में एक simple total मार दो, और ये this expenses should be ignored. You add bad debts written off. चार्टर्ड अकाउंटेंट के बैलेंस शीट में तो बैड डेब्ट्स आता ही नहीं है, बिल ही नहीं आता है तो बैड डेब्ट्स कहाँ से आएगा? बट एनीवे, लेट अस assume कि you have some genuine bad debts. तो most of the people will be following the cash system of accounting, तो bad debts तो आने का सवाल ही पैदा नहीं उठता. But bad debts is not the expenditure in the sense it is not on your running of the business, so that should be excluded. Capital expenditure. Institute says capital expenditure should be reported. I am saying not to be reported. Why? I have a reason. If I read section 32 very minutely, it provides ownership which can be on a pro rata basis also. But from in 5 years of GST, have you come across any invoice where 50% invoice is issued to one person and 50% invoice issued to another person? At least I have not come across. Have anybody come across here? No? One more stand. My top line figure is say 10 crore. My expenditure is 8 crore. My profit is 2 crores. Let's keep it very simple. So I will report say 8 crore as my total expenditure, and I have a capex of say another 10 crore. So if I report capex of 10 crore, so my total expenditure will become 18 crore. System will flash. उसमें 18 करोड़ दिख रहा है प्रॉफिट में, प्रॉफिट लॉस में 8 करोड़ दिख रहा है. मिसमैच नोटिस इशू कर दो, अनएक्सप्लेन एक्सपेंडिचर सेक्शन 69, तो उसका अनदर झंझट चालू हो जाएगा. Why do we need? At least that is my view. But everybody can follow their own view. But my view, we are not. But whatever we are reporting, we are giving the declaration in the observation and remarks of Form 3CA and 3CB. We are reporting, we are excluding this. So disclosure is done and we are safeguarded from the penalty provisions. Next question. Should I consider provisions on prepaid also? In my opinion, we should, because we are taking from the ITR. If I was supposed to go on a payment basis, will I prepare one more set of reconciliation? One more set of financial statements for reporting purpose? I don't think none of us are interested in that thing. So again, I go back to my ITR for which the data is available, which is signed, for which I have generated UDIN and everything. Next, in clause 34 reporting, I need to report the expenditure. Should I report with ITC or without ITC? The answer is without ITC, because you are claiming that as an offset against your GST liability. And I draw my support from section 145A, which provides that if I am following the exclusive method of accounting for the purpose of the reporting of a data, I will do the adjustment on account of the taxes in determining total income as per section 28. Next question that comes to my mind, do I need to reconcile with GSTR 9 and 9C? If you are doing single return, if you can match the data, fine. There can be some instances where you have claimed purchases but you have not claimed ITC because it is not appearing in 2B, and there is a time till 30th November. So that much reconciliation will be pending. But otherwise, if we can reconcile with 9 and 9C, then even our 9 and 9C data can be ready. But let us take another one example. I have 38 GSTN numbers. Since I am preparing my consolidated financial statements of all 38 branches or divisions, and I would have taken care of MIS reporting because of structuring the reporting in such a way that data is derived. So that will help. So to the extent possible, 9 and 9C can be reconciled. If you can reconcile 100%, great, kudos. Should I consider the books of accounts as per income tax, or should I consider the books of accounts as per GST Act? We should consider the books of accounts as per income tax, which are specified under section 44AA. It is for either business or profession. Section 35 of GST says what books and records to be maintained, and it is again supported by the rule 56. I will touch upon section 125 little later after 2 slides. I am not touching 125 right now. Let us see what is the interplay. Under income tax, we have 2 methods of accounting, mercantile or cash. Correct? In GST, do we have a cash system? No. So again I go back to my foundation, I will report as per the mercantile basis, which will include provisions also. And it will take care of the prepaid also. Big question for everybody. मेरा ऑडिट फी का प्रोविजन किया, वो अनरजिस्टर्ड में दिखाया तो तकलीफ हो जाएगा. नो प्रॉब्लम. नेक्स्ट ईयर में और रिवर्स हो जाएगा ना प्रोविजन, व्हेन वी विल गिव द टैक्स इनवॉइस टू द क्लाइंट. इशू किधर है? दिस ईयर इट विल गो एज अ अनरजिस्टर्ड सब एंट्री, नेक्स्ट ईयर इट विल गो इनटू द B2B सप्लाई, बिकॉज प्रोविजन वी विल रिवर्स एंड वी विल pass for the tax invoice entry. Where is the issue? Prepaid also same thing. Ultimately you are reconciling the data with your profit and loss, which is your control point and which will help you for the purpose of the IT assessments also. My view. Again, There are two categories defined under section 44AA, A and B. If I look at notified profession, everybody is aware of. It says income exceeding 1,20,000 rupees, and for individual it is 2.5 lakhs. They are required to maintain the books of accounts. If the new business is set up, then the rule 6F provides when the books of accounts to be maintained. But look at the irony. Carbon copies of bills of sales when it exceeds 25 rupees. This is an old law existing today under the Act, because nobody has read the Act. And expenditure bills in excess of 50 has to be maintained in original. Today though everybody is doing GPay, PhonePe, God knows what they are doing. There is no bill only. And doctors are required to maintain patient register. Doctors I will touch upon little later on clause 44 because it is an exempt supply. But let's look at section 35 read with rule 56. Production records to be maintained, manufacturing records to be maintained, inward supply of goods or services or both, including the RCM supplies, stock of goods to be maintained, input tax credit availed, that is booked in the form of inputs, input services and capital goods to be reported, output tax payable and paid, and such other particulars as may be prescribed. Till today nothing is prescribed. Let me be very honest with you, nothing is prescribed. But take an example. Do you find any similarity in the maintenance of the books of accounts requirement which we report in our tax audit clause? Ki so and so books of accounts we are maintaining. If it is a corporate assessee, requirement of the accounts and records to be maintained, are they not similar? They are more or less similar. More or less similar. So in that case, what section 35 says, where here many people would like to give the declaration ki books and records not maintained. You are giving the platter in the hands of the tax officer. He can estimate tax payable on account of the goods and services on a estimate basis, best judgment assessment. In income tax we know that as a ex parte assessment, and you know once it is ex parte assessment what happens, and then what fight we do to reverse that thing. And that also will be read with 73 and 74. 73 3 years, 74 5 years. Plus rule says for each place of business it should be maintained in the electronic format. Again it says true and correct. In tax audit we are saying true and correct, and here also it says true and correct. And here if I give the declaration saying books and records not maintained, am I not contradicting my own tax audit report? Food for thought. In my opinion, you are. So giving a disclaimer per se is ruled out, completely ruled out. Another thing, if you say books and records not maintained, section 125 general penalty 50,000 rupees per GST in number, 25,000 plus 25,000. 10,000 ऑडिट फीस है, 50,000 रुपया उसको चुना लग गया तो 5 साल की ऑडिट फीस गई. Would you like to take that risk? Don't take that risk. Let's look at the reporting in the financial statements. We are reporting the details of expenditure of manufacturing, trading and in profit and loss account. We are reporting the inventory valuation also. We are reporting quantitative details. Being in the tax audit, quantitative details reporting is mandatory. ITC availed, booked and utilized in clause 27A. There are many people who are of the view that since the words used are Senvet, we will not report the ITC, but in my opinion, I don't agree to that proposition. Because Senvet is under the old and they have not modified so far. It should be reported, but if you are not reporting and putting the observation, fine, no problem. Inventory details we are reporting in clause 35 of tax audit report. In corporate structure, we are reporting the quantitative details of principal items. And typically, whatever report items in corporate notes to accounts, clause 35 reporting in tax audit report and part A reporting in ITR should match. But now let's come to GST ka record maintenance. Table row 5 in GSTR 3B. How many of us report nil exempted and GST supply? Maximum 1% or 5%. That is also, I am very positive. 95% people don't report. Records not maintained. But requirement is there. GSTR 9, we are reporting ITC information in tables 6, 7 and 8. If we are claiming refund of accumulated ITC on account of the inverted duty structure or export of goods or services, we are reporting the details of ITC claimed. Composition supplies we are reporting in table 16, part A. If we are reporting. Table 18, HSN code is mandatory to be reported from this year. You will not be able to file 9 and 9C if you don't report table 17 and 18. Same person is generating GSTR 1, he is quoting HSN code, he is giving quantitative details, he is reporting that in GSTR 1. Can we say details are not available? Again, answer is no. We are in 9C, we are reporting the ITC claim in table 14, which we reconcile with the GSTR 3B that we have claimed. Again, in GST, previous year's ITC can be claimed up to September, and this year something we missed out, we can claim it in the next year. If I follow my books of accounts, I don't have to keep that reconciliation. That is only meant for GST purpose. It is not going to it is not going to make any changes in my financial statements. So again, I go back to my profit and loss account. Let's come to our reporting requirement in clause 44. Total expenditure we have derived, we have excluded depreciation, we have excluded the capital expenditure, statutory provisions of taxes, gratuity or whatever the case may be. It is to be bifurcated into two data, procurements from the registered entities and procurements from the non-registered entities. Let us go to the easy thing first and then we come to the complicated things later. B2B supplies. How many of you use software for GST compliances? Almost everybody? Can you get yearly 2A at a click of a mouse? If you can get that information, report B2B supplies. Where is the problem? Why we are fearing reporting such information? Chalo, 2A is not accurate. Let's assume. My purchase register is accurate, no? Am I right or not? Next question. For 9 months I had GST at 2A, 3 months GST at 2B from 1st January. What do I do? But if I am going as per my books of accounts, and if I am matching my data with my annual 2A report, till the date I sign my tax audit report, where is the issue? You have a support working, no? Put it in your working file. So your B2B reporting is done. Next, composition supplies. In your purchase register, you can identify the suppliers who have not charged you GST. So most probably they will be composition suppliers who are registered under section 10. Pick up sample of invoices. Prepare the summary and report that information in the composition supply. Your 2 column is filled up. Third, exempt supply. Exempt supply is little complicated, for which you need a reasonable knowledge about the GST. But for first 2, you don't need any knowledge at all. Report import karo, summary karo, dal the figure. Simple. Exempt supply will come on the next slide. But typically, exempt supply, composition supply and registered supply, total of 3. When you reduce from the total expenditure, will give you unregistered supplies information. Is it not simple mathematics? Is there any rocket science? Answer is no. There is no rocket science. But let us assume, discuss little deep into it. But before we go, total expenditure, we will, how many of you have passport? Everybody? Everybody have seen ECR? Emergency clearance required. So here emergency reporting required. So remember ECR, E stands for exempt, C stands for composition, R stands for registered supplies. And anything other than ECR is non-registered supply. Khatam ho gaya. There is nothing to worry at all in reporting on this. Electronic challan come return, we are familiar. Remember a concept, this is like just to remember. Let's go to the next slide. We will concentrate on the exempt supplies. Or let us concentrate B2B supplies little further. Tax invoices are there on the record, which are captured in our 2A or in our purchase register with the GST number of the party. SEZ supplies, for which I have received a tax invoice and for which I have filed the bill of entry, also can be covered. Simple. Or there can be some supplies where RCM supply is reported under the reverse charge, GTA, or sponsorship services, or advocates who are providing services other than legal, they are also required to be registered under the GST. B2B clear ho gaya? Composition is also clear where the tax is not charged. Exempt, where it is defined to be exempt supply of goods or services under the GST law, which is a notification known by 5 of 2017. Or a nil rated supply which is notified under section 11 or section 6. Or non-GST supplies. Schedule 3, 8 items. उतना ही बाय करना है और कुछ नहीं करना है. You don't need a GST law. Prepare checklist or reporting मैं add कर दो. But again there is a catch in this. We will see in the next slide. When we look at the reporting requirement in registered supplies, it is asking the bifurcation of exempt supplies, composition supplies and registered supplies, which fundamentally proves if there is a tax invoice issued or a bill of supply is issued and such supplier is registered under the GST provisions, then only that details will come in this particular column. But in case of the non-GST supply, which is like a salary or a director remuneration or high C sales or a custom bonded warehouse, for high C sales and a custom bonded warehouse purchase, you will have the GST number. That will come. But salaries and directors will go as a unregistered supplies because we are following the profit and loss approach. Though institute says कि non-GST supply should not be reported, in my opinion, it should be reported. Profit and loss is only one. Unregistered persons, we know. Imports, if it is of goods, ICE gate details are available. If it is a services, we have a self-invoices under Rule 31. That data is available. You have paid the tax. And RCM supplies, notified under 93, 94, 53, 54. What is the rocket science? Nothing. There is nothing. What is so difficult in reporting in clause 44? There are some of the examples of clause 44 reporting which I have taken only for the discussion's sake. But only one point which I would like to discuss. Interest on bank facilities will go, though even a bank is registered for GST, it will not go as a B2B supply because interest on bank loan is an exempt supply. So it will go as an exempt supply because it is notified to be exempt. It will go there. Wherever you don't have if your purchase register is accurate, your life is much easier. Let it be whatever the volume of the transaction is. Really doesn't matter. Take one more example. In case of there are 2 branches in Mumbai only. If for one place of business, 50,000 invoices are issued, and for the second place of business, 25,000 invoices are issued. And the GST number is not reported in case of that 25,000 invoices due to mistake of the supplier. But he has quoted his GST number. It can be rectified today. All of you agree it can be rectified? But supply is B2B supply only, no? Will it fall under the unregistered supply? No. Your ITC claim is restricted because of the 2B requirement. That is a different story. But the reporting will come under the B2B supply only. What is happening under the GST has got no relevance in this. Absolute no relevance. Once this is done, the next question that comes to our mind, will I report the summary information or will I report the detailed information? Detailed information is for your working papers, but in tax audit, only summary is to be reported because there is no place to write nature of expenditure in the utility or the software. Like Vimnuman is giving the account head details of reporting, but that is not the case as per the utility. So only summary is required to be reported. And your detailed working paper will help you at the time of assessment if it is asked for. 99% they will not ask. 99%. Unless and until there is some reason which I will cover up in the subsequent slides. Why? What will happen? Take the example of a real estate industry. If a builder is issuing tax invoice for the sale of a land, and for a purchaser who is into the construction industry, for it is a revenue expenditure. In that case, depending upon the document available, it will go as an exempt supply, which is Schedule 3 supply. Land and building is excluded. Otherwise, it will go as a B2B supply, depending upon the documentation. So, source document is your invoice, vouchers, and tax invoices. That is what you got to configure. Very simple reporting. Don't take unnecessary stress and get this data prepared from your client. And if they tell you to prepare, tell them, sir, itna charge hoga. Fair enough. I think 99% client will agree for paying extra fees. I'll take up, don't worry. Some of the brain teasers. If I have 38 GST numbers and I am doing inter-branch transfers, will it feature in my profit and loss account? Will it come? It will not come, no? So it is not to be reported in clause 44. For GSTR 9 and 9C, it is a distinct supply. Distinct person supplies, that's why GST is applicable. But inter-branch transfers is not required to be reported in clause 40 because we net out when we report the consolidated financial statements. Interest on credit card EMIs. Credit card charge you, GST and credit card agency is registered for GST. B2B supply. Bad debts is on account of my sales. It is a loss. So loss on fixed assets, loss on account of the stock need not be reported. Provisions we have already done. Multi-GST and reconciliation has to be there. Section 37(1) I am not touching right now. We will touch upon when we discuss the disallowances part. But that is very, very important. But just to tell you right now, if you are doing it at disallowances under section 37(1) or you are doing disallowances on account of any of the sections of the income tax, reporting of clause 44 information has got no bearing. That disallowances is for the determination of a total income as per section 28. For clause 44 reporting, it's your only profit and loss which will matter. Prior period expenses. Some settlements have happened now. So that impact has to be taken in the year in which it has happened. Expenditure of an earlier year also doesn't matter. Same logic. Food for thought. Is it one more data mining exercise by the government? According to me, yes. They would like to examine what is the breakup of registered supplies and what is the breakup of non-registered supplies for the purpose of their analytics. Lot of questions will flow in, especially when you are reporting unregistered supplies details, or you are reporting exempt supplies. They are the only two areas where they can investigate further, and that also GST department. Income tax department is not bothered. But data of income tax is shared with GST and GST data is shared with the income tax. Your composition supply, B2B supply is already reported in GST. So why they will ask you the question? They will not ask you the question. Are we expected to verify each GSTR 2A? If possible, do, or do a sample basis. Do we verify each vendor registration? No. Let client do it. Technologies options are available where we can do that verification. If master data is not configured in the system, ask client to configure the master data. It is to be done every year. They can hire extra people to do that configuration. But it is to be done. There is no choice. If clause 44 is properly reported, in my opinion, filing of GSTR 9 and 9C will be easy. That's why I said it is beneficial to all the stakeholders, including us. Multi-GST, and we have already touched upon. It is an additional exercise, pain point, I agree, I don't deny. But look at the amendment that is introduced for the non-residents in explanation 2A to section 911, significant economic presence. India is not reversing the restraint at all. It is going to stay. And probably in future, few years down the line, the people who are not covered under the tax audit also would be required to report such a information. So if you have a clients for whom you are filing the returns on 31st July, configure their systems well in advance. My personal view. RCM, again, if there is a merger and acquisition, even that information is required to be reported in clause 44 based on the merger documents. If a person has expired, for whom you are filing the tax audit report, that is approved by the legal heir, but you got to report clause 44 information. There is no option. Cancellation and revocation has got their own issues. Closing remark. Considering the discussions of Section 35, Rule 56, Section 125, Section 144AA of the Income Tax Act, and our reporting of the books in tax audit, can we say books of accounts and records have not been maintained? In my opinion, no. Or records can't be compiled. Such stand may be taken, but if whatever the maximum data that is available, you should report. And whatever the language that you use for disclaimer under the observation and remarks, keep Section 125, Section 35 and Rule 56 in mind. Don't give anything in the hands of the GST officer where he can go on a ex-parte assessment basis or a provisional assessment basis. All are known for that thing and they are waiting for that opportunity. This is some food for thought. With this, we will now start on the disallowances. Sir, what was your question? Sir, I can't hear you properly.
So you said only, hi, my name is Bharat. The question you asked was only revenue expenditure needs to be reported, right?
It is my view, sir. Sir, let me clarify.
Yeah. So in real estate, what happens is if the project is under construction, it goes sits under WIP, lot of stuff. Even the revenue does not say happen. So what happens? Those expenditure, how do
WIP,
assets.
Opening balance, you have an opening WIP.
Yes.
You have a closing WIP. Correct? You go as per the architect certificate. So, some expenditure which is administrative overheads, which is debited to your profit and loss account and which is treated as your business loss based on the margin. Or if you are going on a percentage completion basis, or there are two options available, percentage or a project completion, whatever. But whatever you are debited to your profit and loss account for the purpose of the tax audit reporting, that you will consider for clause 44 reporting. Simple. Let us don't complicate the life, don't take a stress. That is what my view is.
Thank you.
Thank you. Any other question? Any question? No? So now is it difficult or is it too difficult? Too difficult? Why? डेटा ही नहीं बनाना है ना, अभी उसका तो कोई सोल्यूशन है ही नहीं ना. Government is after us, and then if we don't report such information and then government says we would like to take away the tax audit also, then whom do we blame? In my opinion, GST audit, same logic has happened. I have been the party to certain discussions, I can't share many things. But this is what is happening. Please do the compliances. Take it very seriously. Don't take it lightly. I am not discouraging anybody. I don't want to demoralize anybody. But please put your house in order. Please, please, please don't take a chance. Things are becoming difficult because of the technology things. Use the technology to your advantage. Invest in the softwares, may cost you 50,000 rupees or 10,000 rupees, whatever. I don't know what the numbers are. But it will really help you. Your efficiency will improve like anything on every count. Please use it. My suggestion. Anyway, let's go to the disallowances part. Tax. How many types of taxes are there? Direct tax? Indirect tax? Any more? Anybody knows any other form of a tax? वाइफ टैक्स, वाइफ को भी टैक्स देना पड़ता है ना? ऑप्शन नहीं है, सॉरी, डोंट फील बैड, देना पड़ता है. ऑडिट वैसे भी टेंशन देता है, इतने चेंजेस हो रहे हैं, सस्टेनेबिलिटी भी रिपोर्टिंग का भी अभी आ गया, कैसे करेंगे? डिसअलाउंसेस अगेन, every time you want to have the brownie points from the client, it doesn't work. In fact, if we disallow properly, client will, if no litigation arises in future, it will help, always help. And tax is always taxing, audit is also taxing, and disallowances is also taxing, as well as the integrating. Let us take some differential between the business. When we look at the business, it involves the activity of buying and selling of goods and services. Size, volume depends on the nature of the activities carried out. But essentially, if we look at the underlying objective, there is a transfer of ownership of goods from one party to another, which is governed by the Indian Contract Act as well as the Sale of Goods Act. And typically for them, 44AD and 44AB will apply based on the limits. But when we are selecting the business codes reporting in tax audit report as well as in the ITR, ensure that codes match. Same logic applies to profession. It is a provision of service. Two parties are involved or multiple parties are involved, but there is essentially the transfer of IPR from one person to another. And that is 44AB read with 44ADA. Whatever the profession codes that you use in tax audit report, use the same codes in ITR. Otherwise, mismatch notices will flow in. Fundamental bubbly popcorn question. Can a company deemed to carry on only business or it can carry on the profession also? For a business, the limit is 1 crore and 10 crore, no dispute, no? Memorandum of association can say anything, correct? But if the company is doing professional activities, will the limit of 50 lakhs will be considered, or will it be always 1 crore and 10 crore? 1 crore? 50 lakhs? Company, if the memorandum says something else, तो क्या हुआ? हाँ, इनकम टैक्स इज इनकम टैक्स, करेक्ट ना? कॉर्पोरेट लोग का कुछ लेना देना नहीं ना? Agree. General view is the company will always carry on the business activity. General view. There can be divergent view based on the facts. So when we are doing the reporting accordingly, do proper care. Take a proper care of that angle. You can. 1 minute. Sir, 1 minute. Let me finish this slide. Can a tuition fees person can offer an income of 6% and 8%? कर नहीं सकते ना, ट्यूशन फी में 6% हो ही नहीं सकता है ना. 44 एडीए कौन बोला? 44 एडीए 50%. It's a profession. Tuition class is a profession. Sir, is it defined under the profession codes? अच्छा, I'll come to it. Wait. रुको थोड़ा रुको, पिक्चर बाकी है अभी. सेम वे ब्यूटी पार्लर पीपल आर ऑफरिंग 6%. कैसे पॉसिबल है? हाई मार्जिन बिजनेस है. Technically, when the activities of such sorts are carried out, we should refrain offering at 6% or 8%. My personal view. Question. Doctor. You can substitute it with a chartered accountant. नहीं वेट नो सर, इतना घाई मत करो यार. बबली पॉपकॉर्न क्वेश्चन पूछ लिया क्या आपने? तो सीधा बोल दिया. अभी ये हार्ट अटैक क्वेश्चन है सर, सुनो जरा शांति से. डॉक्टर अर्निंग फ्रॉम टीचिंग आइदर इन प्राइवेट क्लासेस और अ गवर्नमेंट मेडिकल कॉलेजेस, can he be called to carry on the profession? Answer is no. The reason is doctor is expected to examine the patient, he is expected to write the prescriptions, he has to do certain medical procedures. By doing the tuitions, he is not doing profession, so he cannot be called professional. Even though technically notified profession includes doctor, same logic applies to a chartered accountant. It can be business, it cannot be profession. Be very clear. Be very clear. We will take offline your query. Please. Sir, deduction of TDS under any section is only procedural aspect. But the foundation which you are doing, what activities doing, that will decide the character of a income, whether as a profession or a business. That is very, very clear. TDS can be deducted. I will give you the example of a Reliance. You raise an invoice of 10,000 rupees. They will deduct the TDS. Take the Tata Group, TDS. TDS deduction is only procedural part. Go on a legal basis. We are discussing the legal angle. It is a system issue. It is a system issue. Correct. That is, they are picking up from the business codes also which you use. $44 ADs, sir, certain categories they will be considering as a part of the film artist group. Yes. Yeah. It is happening, yes, it is a true. We are aware about this. One minute, sir, I am coming. रुको यार, क्लॉज 44 क्या खत्म हो गया? अभी सब कुछ चालू हो गया. रुको यार. हाँ? In my opinion, it is business only. No. In my opinion, but yes, there is only one exception which we treat that as a profession. If my memorandum object provide it to be a professional activities, then yes, we are treating as a professional. Otherwise, no. Object clause will determine. Object clause will determine. Take an example. A milk trader is having a turnover of 1.5 crore, all in cash. Whether tax audit will apply? Why? 44 AD. अप टू 2 करोड़ बट ना, सब कैश में है ना. 8%, मैं 8% तक तो पहुंचा ही नहीं हूं ना सर. हाँ तो 8%, 12 लाख रुपया कोई भरेगा? नहीं भरेगा ना. सर एक मिनट, मिल्क ट्रेडर का मार्जिन है 1 रुपीज पर लीटर. कमिंग टू इट, वेट नो, क्यों इतना गाय कर रहे हो यार? आंसर लिखने में 300 मार्क्स लेने में इतना क्यों गाय करते हो यार? टाइम है अभी. नहीं, टाइम बचना चाहिए. एनीवे, सो ही सपोज ही इज ऑफरिंग 8%, ही विल फाइल ITR 4. अगर नहीं कर रहा है तो ITR 3 फाइल करेगा. ठीक है, ऑडिट करेगा. हाँ एक मिनट, चलो ऑडिट कर लेते सर. He has paid 3 bills of 55,000 rupees in cash, which are in excess of 40A3. Will the disallowances would trigger or not? You will say मैं बिल फाड़ डालूंगा, but will it trigger or will it not trigger? It will trigger because section says 28 to 38. It doesn't cover 43, same thing 43B. Restaurant is having 5 crore turnover, 90% cash. Tax audit applicable होगा? Let us tweak the case. Swiggy is paying 96%. Swiggy is collecting 96% in cash. 4% is collected by restaurant. Will tax audit apply? Answer is correct. Why? स्विगी बैंकिंग ट्रांसफर से, बैंकिंग चैनल से ट्रांसफर करेगा तो नहीं आएगा. अंडरस्टैंड द बिजनेस मॉडल, हाउ इट विल वर्क. Builder is getting 15 crore against the under construction project. Whether tax audit will apply? 44AB says gross receipts. There is a Lucknow tribunal judgment of Gopal Krishna which says tax audit will apply. Disallowances in tax audit report don't match with the computation filed. डिजिटल सिग्नेचर मेरे पास है, मैं अप्रूव कर देता हूँ, क्लाइंट को मालूम ही नहीं है, और कंप्यूटेशन में डिसअलाउंसेस कंसिडर नहीं करता, बट टेक अ कंफर्मेशन फ्रॉम द क्लाइंट. रजिस्ट्रेशन डिटेल्स ऑल टू बी गिवन. डॉक्टर कैरिंग ऑन प्रोफेशन इज सेलिंग मेडिसिन ऑल्सो. कैन ही ऑप्ट फॉर 44AD इन रिस्पेक्ट ऑफ द सेल ऑफ मेडिसिन? इज इट पॉसिबल? Yes or no? Notified professionals cannot go for 44AD. वो तुम्हारा पोर्टल यूटिलाइज अलाउ करता है, that is a different story. Don't talk about the portal. But the law says specified professional cannot opt for 44AD at all. Any other than notified professionals can. Firm is opting for 44AD and ADA. Can they claim additional deduction for remuneration to partners and interest to partners? No. Now heart attack question. Can a company opt for presumptive scheme of taxation under section 44AE? No? Yes, कोई बोला? It is. It can. Company can claim because 44AE says any person. Any person includes company also. LLP खाली स्पेसिफाई किया है 44AB के लिए, कंपनी नहीं स्पेसिफाई है, 44AE के लिए नहीं किया है. Same way non-resident also can claim 44AE. He cannot file ITR 4S, but he can file ITR 3. Very important for all of us. We receive the remuneration as a partner or an interest. Can I claim 44 AD and ADA? Answer is no, because if I want to claim, then I am risking myself against the GST registrations. It is a share of profit. So because of that, it cannot be. Only thing that you can claim is a proportion tax, interest on monies borrowed, and any expenditure which is relevant for earning such income can be claimed, which can be justifiable. Very important concept. If we make a mistakes or we make a don't disallow, it can be unintentional or intentional. If it is unintentional, it will be under-reporting of income, which we call it as URI. Remember the movie Yuri the Attack. And if it is intentional, it is misreporting, we call it as MRI. So whenever you are not reporting any disallowances, first decide whether it is URI, URI or MRI, and then consequences will follow accordingly. Penalties would trigger if we don't disallow. Whatever the penalties, judicial pronouncements are there up to 31st March 2017 still holds today. It is still discriminatory. It is not mandatory. Mandatory is only for the levy of 50% or 200%. And there can be either under-reporting of income or misreporting of income. And these terms are not defined under the income tax. It is discretionary, why I say, because based on the show cause notices, if we file the reply, it can be dropped. Section 30 and 31 talks about the rent and repairs. Section 30 provides for the deduction of current repairs, taxes, as well as the premium paid both for the owner of the property or a tenant of the property. Capital expenditure is not deductible under section 30. Personal rent payable is never deductible, and it should be correlated with row number 19 of ITR schedule profit and loss account. There are some judgments which I have quoted in the presentation, which will be shared with you. But I would like to tell you one thing about the judgments. If you are going to refer this judgment which I have given as per the clause wise, don't apply any such judgments blankly. The reason is, every judgment has a different facts, contextual references are different. It may apply to your case, may not apply to your case. So before relying on any of the judgments, I would urge everyone to read the judgment under lens, word by word. Don't go by the head notes. Head notes is given by all the publication agencies, they create. But you have to analyze very meticulously. You may need to read any judgment 100 times. If there is an upfront interest to be paid under the debentures, it is permitted as a deductible expenditure, and there is a Taparia Tools judgment of Supreme Court. But then examine the corporate law compliances suitably. If there is a huge repair expenditure, that can be treated as a revenue expenditure, deductible. IKEA trading judgment of Tribunal Delhi. I have tried to give the judgments of the Mumbai Tribunal or a Supreme Court wherever possible, but if I could not find, then I have given any other jurisdiction judgments. If a no capital expenditure is coming to an existence because such a project is called off because of the commercial feasibility or anything, then it can be treated as a revenue expenditure and it can be deductible. It has happened. And there is a judgment of Magnus Orr, Bombay High Court, which will be to our rescue. But the documentation, management commentary, and disclosure in financial statement will play the significant role. License fee for the software usage, deductible as a revenue expenditure. In case of the repairs and insurance of machinery, plant and machinery, or a furniture, first thing that you need to verify कि it forms part of my block of assets as per section 32. Then only owner, being a owner, I can claim current repairs or a premium paid on such a furniture or plant and machinery. Section 30 talks about owner as well as the tenant, or a lessor and lessee both, whereas section 31 talks only for the owner. Capital expenditure is never deductible, personal expenditure never deductible. Section 32. You can't claim the depreciation on the personal assets. If you have claimed the input tax credit under the GST law, which you have reported in table 6 of GSTR 9, and you have reported suitably in section 32 working also, then on that part of the input tax credit, you can't claim the depreciation. Self-created goodwill, you can't claim, but acquired goodwill, you can claim the depreciation. If you have owning the asset and you are a legal owner, you can claim the depreciation. If you are not a legal owner, you can't claim the depreciation. Other thing, very important. If you have no business activity carried out as per your financial statements, then depreciation is not deductible. There is a judgment on this particular point, which I will share with the, it's a recent judgment, which I will share with the convener, which can be circulated with all of you. Here is the issue of partly owned and or co-owned fixed asset, which I was talking at when we were discussing the clause 44 reporting. Under income tax permitted, under GST there is no such concept. But if you have acquired the asset and it is ready to use, depreciation can be claimed. Fees paid for the increase in authorized capital, if you have capitalized to plant and machinery, you can claim that as a deductible, or you can claim the amortization as the case may be. If you are not a legal owner, no depreciation. If your composition and a component says it is an integral part of the computer system, then you can claim the depreciation at the rate of 40%. But if it is not, it cannot be proved. Then it will go like, for if you buy an iPad and a laptop, iPad will go as a plant and machinery 15%. But if you have a server systems and for which you incur the substantial cost on the routers, then it can be part of the computer system. One more thing. Software, again, depreciation is eligible at 40%. There is a specific entry was introduced in 2014, and even a head note was introduced later on. Additional depreciation can be claimed only if there is a manufacturing activity. If there is no manufacturing activity, no depreciation. Self-created, we have already discussed. Interest on monies borrowed can't be claimed if they are for a personal purposes, but if they are for the business purposes, whether capitalized or not capitalized doesn't matter. But anything prior to the prior period, such asset is put to use, you can claim that as a deductible. And reporting of ITR I have provided. Section 37, very important next 2 slides. CSR expenses are mandated as per the Act, so it can be claimed as a deductible. But if you incur the educational cost before you set up the business, then it is not deductible. But if you incur the education expenses subsequent to the setup of business, you can claim provided it can be justified. Very, very significant amendment for applicable to assessment year 22-23. Explanation 3 has been added to section 37(1), which says that if you incur any expenditure which is in contravention of any law, whether in India or outside India, then such expenditure is not deductible. Best example that I can give you immediately, all of us will be having a two-wheeler or a four-wheeler. We break the signals. Debit to motor car expenses. That is disallowable under section 37(1). There was one point which I had said, we will discuss when clause 44, 37(1). But before I touch upon that, let me take you one more example. I have a chemical industry. My production capacity permitted under the Factories Act say 100 million tonnes. But I produce 200 million tonnes. I will procure the goods, pay the supplier, claim the ITC, sell that 100 million also, pay the GST also. But since I have not taken the permission under the Factories Act, it can be covered under 37(1). So means all expenditure that I have done for the additional 100 million tonnes can be disallowed. Legally it will not sustain, but if I look at the literal reading of this amendment, it means that. One more example, for a chemical industry, if 100 million tonne production capacity is permitted, they are permitted to dump water up to a particular limit in the drainage system. But due to 200 million, double the capacity, that dumping will be doubled. And if there is a issue for the normal public, and if there is a police complaint and all, such matter can travel under the PMLA provisions also. Another example, FMCG and the pharma. Typically, expiry is specified under the packaging, but they repackage such a goods in reality and then again resell it. If we come to know it is a violation of the provision, again that will cover under 37(1). Another example of a tea industry. Lots of tea vendors exported the tea to Brazil, and Brazil rejected the consignment. The reason was FSSI registration was not taken. It is there on the tea board website. Another example, for a pharma, freebies are given to the doctors, which is the violation of a law. So it is illegal transaction. So it will be disallowed under section 37(1). But transaction being illegal, even ITC would be disallowed under section 16 of CGST Act. Look at the integration that is happening between IT and GST. If you do illegal activity, that is not deductible. PRA Singh judgment still holds the fort. But with this amendment, things have changed. So when we are examining the legal and professional charges of the client's profit and loss account, be extra cautious to see what is happening. These are the repeated. Section 40 is a specific disallowance. So far what we have discussed is hidden disallowances. Now it is express disallowances. For a non-resident, we don't deduct the TDS, 100% expenditure is disallowable. For domestic supply, TDS is not deducted, 30% disallowance. But for the purpose of reporting in clause 34, we will report 100% of this expenditure and 30% will be auto-picked. Presumptive scheme people, 30% disallowance will not apply, but there is no waiver of penalty under section 271C because of the limits specified by the amendment. That is another change. Double taxation avoidance treaty will always have an overriding impact on the direct tax provisions. If the reimbursement of expenses for which the compliance is done by the agent, then the TDS is not required to be deducted by the principal, and there is no disallowance. If a payee is not identified, amount payable is not ascertained, no tax is required to be deducted at source. Especially, but then it will be treated as a contingent expenses and it will be disallowed by reporting under clause 21G. Incorrect withholding of TDS again will result into disallowances. Very smart accountants, provision made, payee identified for reporting, TDS deducted appropriately, TDS return filed, TDS certificate issued also. It is only to reduce the profits. In that case, it will be disallowed as a contingent liability. In that case, it is not deductible. We should ask client to revise the TDS returns and report it accordingly. And if they don't revise, qualify it suitably. Because we are reporting true and correct. Book entries recorded and reversed under section 195 will not trigger the TDS. Overseas taxes are paid by the taxpayer. They are not deductible as business expenditure. TCS judgment. No disallowance due to short deduction of TDS. Earlier that was the case, but now that reprieve is available to us, we get a payer's chartered accountant certificate and that should suffice. If a VAT is charged, no TDS. Now if HSN is charged, typically from 1 to 94 or a 95. 95 is very limited applicability. TDS may not apply as a reference, but anything which has a service accounting code use of 99, TDS will trigger. If it is reimbursement is and there is not an income of a recipient, then the TDS is not required to be deducted, provided the pure agent concept is satisfied. Commission paid to overseas agent, no TDS required, it will not be disallowed. Bombay Stock Exchange fees, revenue expenditure, no TDS required to be deducted. If it is a composite supply and which amounts to a supply of goods, then the TDS don't apply. But if it amounts to a supply of services or a composite supply, then TDS will trigger. We have to use the references of GST to take a support. Remuneration to partners, non-working partner, remuneration not deductible, interest in excess of 12%, that is simple interest. Only up to 12% is permitted, anything above 12% disallowed. This we should remember, simple, Bobby Ma dimple. Take care of that thing. Remuneration has to be deductible as per part 5. They have specified the limits. According to that, book profit has to be computed and it should be considered accordingly. Related parties, this slide is very, very important. Please finalize related party transactions before you upload tax audit report. Don't do post filing of the tax audit report. Ensure such expenditure that you are claiming is reasonable, it is not excessive and it is unjustifiable. Director remuneration, typically we know it is paid on a monthly basis, but it can be paid on a percentage basis. There is a 1968 circular on that particular point. At the same time, one care should be taken if you are paying as a percentage, 192B compliance as well as 222E compliance. And if there is an international transaction, even if it amounts to a rupee 1 transaction, transfer pricing audit report is to be filed mandatorily. So due date of filing of the tax audit report and the ITR will be aligned accordingly. And this is examined very, very closely by the department under the corporate law also, as well as under the income tax law. Under corporate law also now, we may be Companies Act people can come to our client's office and see everything. If you have disallowed under any other section, then 40A3 will not trigger. Transporter, the limit is 35K, and all exceptions are already provided. 40A3 is a very old law, there is no change. Provision for a gratuity. If there is a contribution to the approved gratuity fund, then it is deductible, but if it is a provision for gratuity created, then it is to be disallowed. But many people report contribution paid to the approved gratuity fund, also report under the provision for gratuity, and then we say system is wrongly processing the data. Be very careful. Provision or approved gratuity are mutually exclusive. Both cannot come simultaneously. And if you have filed the application and is pending approval, then also it is deductible. There is a judgment. Narasu spinning mills. Such ratio may be applied to other statutory registrations also. Other contributions other than statutory. If they are mandated by law, then only they are deductible, otherwise no. Setup cost not deductible under any scenario. Mark to mark losses, it is only exceptions provided under section 36. That is to be kept in the which are allowable, otherwise everything else is disallowable. 43B, we got to be very particular. If you are considering the opening balance, please verify last year's audit report, allow it appropriately. Or if you are paying before the due date of filing of the tax audit report, no problem. But if you, on the date of upload of tax audit report, statutory liabilities are not deposited by the client, you will disallow under 43B, but thereafter you can revise the tax audit report. That is permitted. If you have used monies borrowed which are covered under 43B, then that can be disallowable. Capital expenditure, personal expenses, penalty or fine. Here, late fees payable under GST or under the 234E should not be reported here. Expenditure incurred by a membership of a club, not deductible. Availing services of the club, not deductible. If you have given the advertisement in the political parties, not deductible. Contingent liability. Last year we have seen many people, whatever the contingent liability is reported under the Companies Act, they have reported it here. Here the contingent liability means the expenditure which is contingent in the books of accounts and which is debited to the profit and loss account, that should be considered. Not what is reported as the notes to accounts of Companies Act. Direct tax, if you have debited the profit and loss account, disallowable. Interest on monies borrowed for payment of direct taxes or TDS, disallowable. Very important. Interest paid to MSME units under section 23, expressly disallowable. MSME may charge you tax invoice. You may have deducted the TDS. All compliances you have done. You may have claimed a ITC. But if it is in the nature of interest, disallowable. And this is mapped with MSME 1 that you file under the Companies Act. Expenses of earlier year is only relevant for the purpose of mercantile system of accounting. Cash, that does not arise. TDS reporting. Looking at the changes that are getting introduced in the TDS provision, in my opinion, it is a separate audit by itself. Scope is too wide, and probably in future we may have a separate TDS audit report. Very fundamental question. In case of the merger and acquisition, company A is getting merged with company B. Company A is deducted several TDS transactions using their own TAN number. But now we are filing the merged entity return. So will we report TDS transactions of company A in the tax audit report of company B? Answer is yes. Different TAN numbers are provided to be reported. But when you are filing ITR 6, please report such a information about the changes. Next, if I am paying rent, if I am paying maintenance charges, rent is I am paying to the landlord, maintenance charges I am paying it to the landlord. But maintenance charges are paid to the society, but not to landlord directly. Same way, property tax I am paying it to the government on behalf of landlord. TDS would be required to be deducted on rent component, maintenance as well as the property tax, because maintenance expenses are not in your name, they are in the name of a landlord. So 2,40,000 limit will be aggregate of rent, maintenance and the property tax. If there are some expenses which are reported in GST on which the TDS is deductible, but if it is not payable, then you need not consider deduct the TDS and that should not be reported. But you should communicate to the supplier that they have wrongly reported, and such communication should be kept on record. If interest payable is not provided in the books of accounts, it should be provided and it should be reported in clause 34. Due date of filing returns, whether all reportable transactions are reported or not, that is to be considered. We are touching upon the part 5 of the presentation, GAAR. TDS I have not discussed much because everybody is familiar with the TDS. GAAR. Again, this is the second uninvited guest. How many of you are reporting GAAR? Anybody? Anybody? No? Chalo. Still discuss kar lete hain. It is chapter 10A. But when I was looking at the definition, it is impermissible. But then I thought that probably they wanted to write, I am possible. Is it really possible? Why they did not use the word evasion instead of avoidance? Why they did not use planning word in place of the arrangement? There is a lot of thinking behind using these words. The reason is they didn't want any litigation arise on account of the judgments at the international court level. But when I look at the GAAR provision, scope is inclusive definition, very wide. It says tax benefit includes increase in loss. Loss बढ़ गया तो भी GAAR आ सकता है. Increase और decrease in tax हो गया तो भी GAAR आ सकता है. अगर टैक्स डिफर हो गया तो भी आ सकता है. रिफंड बढ़ गया और कम हो गया तो भी आ सकता है. सेम वे इट इज एप्लीकेबल टू द इंटरनेशनल ट्रांजैक्शन and it is applicable to all the taxpayers. So resident, non-resident, both are covered. This is the game. So now let's understand. This is the broad scope of GAAR. It starts from section 95 to section 102. 95 has the rules as well as what forms to file. Section 96 defines what is impermissible avoidance arrangements. Section 97 says कि which arrangements will be termed as lacking commercial substance. Section 98 says what could be the consequences. And section 99 says what could be the treatment of GAAR if they are declared as an impermissible avoidance arrangement. Section 100 says the applicability of this chapter. 101 gives the guidelines. 102 is a definition. So when I look at the provisions of 102, a separate definitions are given which are applicable to only this chapter, which is 10A. So it is a code by itself. Every section, if we look at, we know section 2 is a definition section under the Income Tax Act. But each of the act, each heads of income also has a separate definition for each term defined, which governs that particular section provisions or under that incomes from salaries, house property, business income or capital gains and so on. Same way, same logic is applicable to GAAR. Section 144BA, which is a governing section, which is applicable from 1st April 2016, which provides for a reference to commissioner. And this has to be done during the assessment proceedings. And assessment proceedings will include reassessment proceedings too. If assessing officer feels any arrangement to be declared as an impermissible avoidance arrangement, he will determine the consequences. Then he will notify the commissioner. Commissioner will apply his brain. And if he feels it is a fit case, notice would be issued to the taxpayer. Taxpayer can file reply, can file the objections. He can seek personal hearing. And this is to be done within 60 days. If no objections are filed, that arrangement will be termed as the GAAR arrangement. But objections are filed. But if commissioner feels satisfactory, then he will drop. But then he has to pass a speaking orders, writing the reasons why he is dropping such a proceedings. But if it is not dropped, then the matter is referred to the approving panel, which consists of 3 members and 1 member is High Court judge. Such approving panel will declare such arrangements. It is applicable to which assessment years, to which transactions, whether it will cover 1 year, it will cover multiple years. But before declaring such arrangement, they will give one more opportunity to the assessee as well as the assessing officer to prove how it is prejudicial to the interest of assessee or a taxpayer. They will re-examine all the documents, and if all 3 members agree, then it is declared. If 2 members agree and 1 don't agree, again it is declared. 1 member agree and 2 members don't agree, then also. So rule of majority will prevail. But once it is declared to be impermissible avoidance arrangement, it will be binding on assessing officer, it will be binding on the commissioners, and it will be binding on the authority of advance rulings also. Term of the approving panel is 3 years, minimum 1 year, maximum 3 years. And the chairman will be High Court judge. He cannot be anybody else. Limit is tax benefit of 3 crores in any form. Every nature of transactions will be examined. What it will entail, once the transaction is examined, it cannot be repeated again as a GAAR arrangement. It is overriding double taxation avoidance treaty as well as the MLI. Such arrangement will waste rights and obligation without arm's length pricings. If it is arm's length pricing, then we need not worry at all. So SAR provisions, what we are doing, that is 48(2)(b) or AS 18 compliances, which are justifiable, then SAR will not be triggered. Welcome, Arbet. It is a misuse of or abuse of the direct tax provisions. Commercial substance is missing. Transactions executed are not bona fide. So substance over form will prevail. It is like similar, we have a knowledge of window dressing, especially the disguised transactions involving round tripping, offsetting, accommodation entries, fake and bogus entries, hidden values, hidden locations, hidden beneficiaries, hidden ownership of the structure. And intention of all the parties is to garner only tax benefits by establishing the units in the tax jurisdiction benefit. And if business risk is missing, or there is no net cash flow arising from such execution of transactions, then only such arrangements can be treated as an impermissible avoidance arrangement. And if it is declared, what will happen? It will amount to lifting of veil, similar to the concept of corporate veil lifting. It would be treated as if no such arrangement is ever executed. Disregard to the properties involved in such accommodation. It can be in the form of equity, debt, income or expenditure. It can be disregard to the corporate structure. Concerned parties are treated as the same person. Reassignment of residence as well as the status of assets or transactions, or a relocation of income and expenses and relief. So, when we are preparing our audit checklist for the purpose of doing the audit, either under the tax audit or under the corporate, are we supposed to be extra cautious while examining such a transactions which are done? And can, as an auditor, can we report such transactions? It's a moot question. And if such transaction is reported by us, whether the directors have reported in their directors report or we have reported under CAAR, and suppose it is a group of companies and you are an auditor of only one company, do you have access to the group records, group company records? My answer is no. So how will you report? Is that possible? Some of the sensitive areas, supply chain business arrangements, whether related parties or unrelated parties, corporate restructuring exercises, employee remuneration policies, ODI or FDI arrangements, apportionment and allocation of cost overheads between a KPO, BPO, head office and subsidiary, transfer pricing arrangements, related party transactions, merger and acquisitions amongst group concerns, FTS or royalty agreements, business promotion agreements, intellectual property assignment agreements, financing arrangements. It is only, I'm just illustrative examples I'm giving you. So canvas is very wide. So here moot question is, do GAAR provisions apply for AY 22-23, that is clause 30C reporting? Answer is yes. If any agreement is declared as the impermissible avoidance arrangement, can taxpayer file the appeal? Answer is no. It is not appealable at all. If yes, I have said it is applicable, whether such clause needs to be reported. I will take up this answer after the next slide. Let us assume it is declared as an impermissible avoidance arrangement. Will it amount to ease of doing business? What would be the cost of reversing such a transactions? Whether more clarification is required? In my opinion, more clarification is required. Will such clause would be deferred once again? Answer is no. Will it adversely impact international trade relations? Answer is no, because all the countries have agreed to such a proposal under the international taxations. Will it trigger international tax litigation? It will trigger, probably it is driven by the political cloud, otherwise no. But now I come back to my previous question. Whether such clause would apply. What is the view of the House? Will it apply? Will it not apply? Should I give the answer? Answer is very simple. First of all, such arrangement has to be declared under section 144 BA. If that is not declared, this clause is not applicable only. Other extension, approving panel itself is not constituted till today. So where is the question of 30C? So no GAAR applies in any of the audit reports. You can simply write not applicable. Again I come back to my First slide. Death and taxes is certain, but let us be pound wise and even penny wise too. I appreciate all of you, and I always say, surround yourself with the people who talk about vision and ideas, not people. Thank you. With this, I hand over the proceedings to the convener. Thank you.